What's going on, guys? Welcome back to the channel. In this video here, we're going to be doing a stock analysis on PayPal. Now, the earnings were just announced. The price of the company has been going up by a considerable amount. I think they're up 10% today. So we'll pull this up in the stock research tool here, and we're going to do an analysis based off the fundamentals and financials and finally determine a price to pay for this business. So taking a look at PayPal right off the top here, we see this trend line, and from mid 2021 down to where we currently are now has been ultimately a huge decrease in price. We were sitting at $310 a share, and now we are currently sitting, at the time of recording this video, just around $92. So it's interesting to see the sharp decline that we've been experiencing with this company. And now that they've released their earnings, they've been jumping up. So let's see if it's all overpriced or overhyped rather, and see where this company currently stands. We are ranking this company a 7 out of 10 in our financial evaluations category. So let's scroll through these numbers now and see what that means. So with our 5-year PE average ratio, we are currently sitting at 55. We want this to be underneath 22.5. Scrolling to our trailing 12 months, we are sitting at 25.90. Now, that is an improvement, but it's high nonetheless. Now, the only reason we can one of the reasons we can justify this number is if they can continue the growth that they're having, but that's a high number. We don't really want to see it at that amount. Our current ratio is currently sitting at 1.22. We want this number to be over 1.5. Now, what that would mean to us as investors is that on hand, they would have enough assets to cover the liabilities. Currently, as it stands now, a 1-to-1 ratio isn't entirely bad, but we want that 0.5 as an additional margin of safety, folks. So that 0.5 is crucial. So 2 zeros starting this off. Now, moving into our return on equity, we're sitting at 15.87. Now, this is a pretty good number. We want this to be over 15%, and that's for our average score over the last 5 years. That's pretty decent. And our trailing 12-month number, if we just scroll over to our company metrics category for a quick second, that is sitting at 19.81. So that's pretty good. EPS growth, massive EPS growth over the last 5 years, a 255% increase. Our debt to equity sitting at 37%. Now we want this number to be under 50%. We have that, which is phenomenal. That just means from a leveraging standpoint, are they building this business through equity, or are they taking on debt to finance or to grow the business that way? We want this underneath 50%, folks, and that is a healthy number sitting at 37%. Moving on to our share dilution category, we are being slightly diluted. Now, it is very minimal, but it is a dilution nonetheless. It's 0.09%. Now, this is something I could probably just not even worry about. But ultimately, folks, we want this number to be staying the same or decreasing in shares. Now, the reason we want that is because that'll give us more ownership of the business. So imagine you have a pizza slice, or a pizza pie rather, and let's say there's 10 slices. You have one slice, and then they start cutting up more slices. Well, your ownership of the company, even though you have one slice, now let's say there's 12 slices, you still have one slice, but now that slice is smaller because now there's more issues or more shares, pizza slices being issued. I've explained that horribly, but essentially what we want is this number to be being decreased. Now, moving into our net income, now I'm liking this. I'm liking these 4 categories here in the greens, because that indicates to us that we have a net income that's growing. Our free cash flow is growing. A healthy return on invested capital sitting at 11.78. We want this to be over 10%, and we have that. And our revenue growth is at 18.55% over the last 5 years. So overall, not too bad, not too shabby with PayPal. Now, scrolling over to our return on equity at trailing 12 months, we are sitting at 13%, so that's good. That's somewhat of an increase over our 5-year average. And our free cash flow, our average 5-year free cash flow is $4.2 billion. And currently, our trailing 12 months is sitting at 5.43. So they are up. They're up. And with a lot of business being done through PayPal, and now I know from at least just an e-commerce space, you know, you could pay through different online websites with PayPal, even with the whole crypto sphere of transferring. And let's say if you had to offload your crypto and let's say cash it out, you can cash it over to PayPal accounts. So there's a huge spike that I've noticed in people signing up for accounts and actually utilizing PayPal. I mean, just in my own, just speaking on behalf of myself and all the other services that I use, I would only imagine what if you multiply that by whatever their current count is of subscribers or user base. It's, they have a really large market. So with that in mind, folks, what do I think about PayPal based off what we see here? I like it. I actually really enjoy this business. I think it's a major player in the financial services ring. Now, let's see if this price makes sense. We're going to jump into doing a price analysis. But before we do that, folks, if you're enjoying the video so far, please consider liking the video and subscribing. Makes me feel warm and fuzzy inside and helps out the channel a lot with the YouTube algorithm. So let's jump into a price analysis and discuss what a potential price to pay for this company. So we have a lot of numbers to work with, and what I like to see here, folks, a lot of positive numbers. This means they have pretty consistent growth. It looks like 5-year, 1-year, 10-year, all sitting around that 18% mark. So this is going to be a lot of fun to work with. Give me a second while I populate our estimates here. I'm going to do 3. I'm going to do conservative, moderate, and aggressive over a 10-year period. So I'm going to populate these boxes. I'll get back to you in just a quick second. All right, folks. So just scrolling down here. These are the boxes. Here's my assumptions. Now, I put a pretty conservative amount for our revenue growth. 16 on the high side, 12 on the low end, because I want to see what's the lowest that this company can do over the next 10 years. I want to make sure I have an ample margin of safety, and if you know me, I like to keep things conservative and see how essentially it'll play out. This is what I think it should do. This is the unicorn list, essentially. Pretty much keeping out what they're currently doing. And now profit margin, I'm going to hover, just give myself a slight margin of safety. Let's say profit margins, let's say they stick within that 13 range. Maybe just a slight discount on the conservative and moderate side. Same thing with the free cash flow margin. I want to keep that just slightly under 20 because I know that they can hit that in the 10 years that in the 10-year numbers here. So I did 2019 and 18. Now, price to free cash flow, I'm going to keep that with 14, 16, and 18 because I feel like if they're able to hit 19.88 and over the next 10 years, they should be able to hopefully hit 14. 18 seems a lot more probable. Now, the PE ratio, same thing. I've kind of gone a little bit more conservative on this approach. Now, granted, our 5-year average PE ratio is 55. We're currently sitting at 25.90. Now, this is a $100 billion company. I find $100 billion to $200 billion companies are the hardest to work with because depending on the infrastructure and or how this company is performing, it's at the tail end of its runway or a lot of runway will be set up. Now, with the course of PayPal, I might be a little bit too conservative with these numbers here because as things become more online and this service becomes more integrated, it might make sense that it might yield a higher PE. However, I want to be able to pay for something that's underneath this 22.5 range. So with that, I might just go 20 on the high side. I'll go 18. I want to be somewhat conservative. Now, we're going to put a desired return in, folks. And what I like to do is put 13% and see where we're currently sitting at. Okay. All right. Very interesting. Very, very interesting, folks. Take a look at this. $160 for our average calculation. Currently sitting at $91. Let's look at these assumptions here, folks. I'm liking this conservative average right now. I'm kind of mad at myself. The price increase, we hit a low of what, $82? Now it's currently at 91. Not bad. A decent margin of safety here. And this is the categories I want to see the most. Is it going to be Greene within our conservative and moderate category? Aggressive is not so bad. I'm not saying I dismiss that, but this is most likely going to hit regardless. But take a look at this. Assuming a PE ratio of 14, low revenue growth. Look at that. I've discounted the revenue growth by 6%, essentially, over a 10-year period. Profit margin, I've discounted that. Free cash flow margin, I've discounted everything. And we're still showing a price of $111 to pay for this business. Paying $111, roughly over the next 10 years, you'll be making your 13% return. Currently sitting at $92. It's looking very attractive. So, if you know me, I don't really watch the news. I just kind of analyze businesses, see if I like them, see how they make their money, and then kind of go from there. So when I hear little things and rumors that, oh, the price has gone up because of earnings release, I try to see, okay, well, is this justified, and how does that affect, let's say future value, right? Now, I get more excited when earnings go down, because then companies might be trading at a discount. Now, with the course of PayPal, I'm still excited because this is a company that's being shown from a price perspective to be undervalued. However, now if there's excitement being rallied behind the stock, is that going to skew my future investment? Not really, because look, based off of this, and these are the numbers I'm really working in, 111 to 157. 157 is, my margin of safety is slowly decreasing. So if I go to just go 13% revenue growth, out of curiosity, 143. So if I hit my ceiling of 143, if I buy within this window here, I'm pretty much laughing. We're actually below this window. That's even better for us. We're getting an ample margin of safety on this business. Now, based off the calculations that I've shown you here, folks, does that mean you go out and buy PayPal? No. You have to do your own due diligence. Now, this software that I have in front of me helps me do that in an instant. If you'd like to obtain this software, stay tuned. It's becoming an app. It's going to be available to you, my subscribers. So this helps me price out different companies, and then from there, I can take a look at other different aspects of the business. And if I want, I have my income statements, cash flow, balance sheets, and there's more features that are going to be integrated as well. So stay tuned for that. But I can just take a look at what the deeper story is of PayPal. So this is a business that I'm liking. I love these stories. These are the stories that I like. I love a story that this company's been beat up over the last year and a bit, fallen to less than half of what it currently was at. And now it's undervalued based off the metrics that we're showing here. PE ratio is a little bit high, but based off these metrics that we're currently showing, the price seems right. Now, am I going to pick it up? No, not yet. I need to do more homework, personally. But I got to say, the price has me curious. The price has me interested. So that's my 2 cents on PayPal. Remember, folks, do your own due diligence. Stay tuned for more videos. Thank you so much for watching. I'll see you in the next one.